IWMY, which is a Defiance 100% dividend yield ETF, which tracks the Russell 2000 Small Caps Growth Index. Without any further ado, if you guys have liked the previous videos, make sure you like and subscribe for more of them. But let's get straight into it. So, what is IWMY? As I just said, it's a put-right ETF on the Russell 2000 that uses daily options to get yield for investors, which is paid on a monthly basis. Essentially, what that means is they write options that are generally puts on the Russell 2000 index on a daily basis, and they write them on the RUTW, which is the weekly options chain, I believe. And they do this in order to generate the yield for their investors. So let's get into their holdings. As we can see here, they have a lot of treasury notes and bills, treasury note bonds for about 2.625%, First American government obligations, and we can see that there's a covered put for about $684,000 in the portfolio. I believe that the reason they keep a lot of treasury bills and treasury notes is in order to pay all of their investors and have cash on hand at all times in order to do this. And they get the yield from the treasury notes, and they're able to pay out the investors on a monthly basis, essentially. But there's actually something more interesting about where the yield comes from that I'm going to get into a little bit later. But I think it's imperative that you guys know about the holdings. So here they are so you can see them. But now I want to get into something called return of capital. So with a lot of these funds, what a lot of people don't cover is where the actual distribution comes from. Now, this is not necessarily a bad thing, but it's something that's important for you to know. And as you guys might recall, if you've been watching this channel for a long time, we've been going over a lot of closed-end funds as well. And a lot of these funds, including these option right funds, such as the one we're covering today, IWMY, they use return of capital. So essentially what return of capital is it's your own money being returned to you. Now, again, this is not financial advice. If you watch my videos for entertainment purposes only. However, if you are investing in these funds that are returning you capital, then it's very imperative that you talk to a CPA so you understand the tax complications of doing that and other things like that. But destructive ROC is something that you want to keep in mind when you're investing, because that can also eat away at a lot of your returns, right? So when we're buying traditional dividend securities, such as something like Coca-Cola, those dividends are coming from the actual company's revenue and being paid out to investors with whatever excess cash that they have after reinvesting, paying employees, etc., etc. However, with these funds, if we actually take a closer look at where the investment income comes from, we can see that about 4% of the distribution is from the actual net investment income. Now, if we look at the rest of what the return of capital is, it's about 95.77%. Now, you may say, oh, where did you get this from? This is directly from the Defiance website. So it's just important for us to know this, because every time that they're giving you back your money, your cost basis is going down as well. So yes, these are great tools to get a lot of yield. And if you understand this and you use them diligently, then it can be beneficial to you, because you can possibly, and again, consult a CPA, bring down your cost basis and invest the yield that you're getting from this fund somewhere else. However, I'm not a tax person, and you should talk to your tax person to figure out if this is, useful for you or potentially doable for you. But let me get into what the compounding effect of this fund is, which is absolutely crazy, which is also makes me beg the question of, is this going to be around for the longest time? Is it not? I have my own money in it, so only time will tell. But let's look at this. So we have a starting balance of around $10,000, and every year we're accruing interest, right? So if we look at the first year, it's about 7.9K. Second year is 14, and this is assuming that everything is reinvested back into IWMY. Third year, we're at 25K of interest, all reinvested, of course. Fourth year, we're at 46K. And 5 years, you're already at $82,000. So at 5 years, if you had ideally wanted to live off of $82,000 a year, you could, off of just $10,000. But this gets even crazier, right? So we're assuming the yield after tax, because right now it's saying that the yield of IWMY is about 100%. With a lot of these super high yielding option right funds, they're like some crazy yields between 50 to 100%. Let's continue this, right? Let's continue this. So past 5 years, we keep going. We're looking at number 6, right? 148K a year. So let's say you are 21 now and you want to put 10 grand that you'd saved up from your job or whatever else into this fund. So we start, and 22, you're at 7.9K a year. 23, you're at 14,000 a year. 24, you're at 25. 25, you're at 46,000. 26, you're at 82,000, and at 27, you're at 148K a year, which is like a higher salary for most people, right? But it gets even crazier. If we go to number 7, we're at 266. Number 8, year 8, we're at 479. Number 9, we're at 861, and number 10, we're at 1.5 million, right, of interest that you're making, right? And at that point, it takes about 8 years to be a millionaire off this fund, which is quite ridiculous if you reinvest every monthly distribution. Obviously, this is compounded monthly because they pay out monthly distributions, but just for the sake of this fund potentially going kaput at some point in the future, I have a different strategy that I'm going to employ. And again, this is not financial advice, but I would suggest that you guys take the same path as well. My strategy is this, okay? So let's utilize the yield to invest back into the S&P 500. Now you might ask why that doesn't move. It only has 9% a year. However, it's something that's always going to be there, right? I mean, we don't know that these funds are going to be here for however long that we can say, maybe more than a few years. So if we have 100% dividend yield, if this fund is at least here for a year, we've already made our 50,000 back. Of course, we've made about 35 because if it's 100%, you take out taxes, a tax adjusted yield of 70%. Let's do this math instead. So let's start with this 50,000, whatever, in IWMY, and we'll just take the yield monthly and take the taxes out and put that into SPY. Now, at 10 years with just 50K, what are we looking at? Now, this is where it gets crazy, especially if you're someone that has a lot of money. So if this fund is around for a very long time, and let's say it does go down, it goes up, like we can assume that 50,000 goes kaput as well, right? Over that 10-year period, we're not looking at that 50,000 principal, but what we are looking at is the 10-year compounding of essentially the quarterly compound of the dividends. The SPY is not included in this calculation, by the way, but this is just the 9% per year appreciation accrued yearly. So if we look at this right here, we can see that we're about $568,000 from 50,000, which is quite a lot, to be honest. And this is the path that I would take personally. But again, you're free to do whatever you want. This is not financial advice, but that is my strategy when it comes to these high yielding funds. However, that is all for today. I hope that this small, insightful video was somewhat useful to you guys. I like to kind of throw back my ideas, and if you guys have any questions or anything you want to say or any recommendations, type in the comments. Like for more videos and subscribe and hit the bell notification so you guys can see more in the future. But that's all from me today. Y'all have a lovely weekend, and I'll see y'all in the next one.